All right, it is New Year's Day 2025, and I am with David Lotan. He is a private investor. He's also chairman of a junior mining company, AU, on the TSX Venture. But today I've invited David to not talk about Finland so much or his company that he owns over 10% of the outstanding shares in, but more talk about the gold mining sector, the junior mining sector, a little bit of macro. We'll see where the conversation goes. I find David's views and his insights to be quite rare. I don't know many people who know the sector much better than David does. So here we are. David, how are you today?
Very good, Robert. Thanks so much for having me on today.
My pleasure. And thank you for joining us here on Goldfinger Capital. I think this is a real treat. I'm not exactly sure where to start the conversation, so I'm just going to just randomly pick a topic and we'll just see where it goes. A lot of investors that I speak with um, in the last couple of weeks, we're talking about investors in the junior mining sector largely. You could say gold miners more broadly. While they may have done okay in 2024, their portfolios may have been positive. Not all of them. Some people definitely were in the red in 2024. There is a largely unsatisfied feeling about the year overall, especially how the year ended, the final couple months. Um, what happened in 2024? I mean, this is a year where gold rose almost 30%, yet most investors feel like they got shortchanged.
Mm, that is a big question, a big open question. So where would I start with that? I think, interestingly, the real significant leg, I'll call it, in the gold bull market that emerged just around or after PDAC was always going to collide with presidential politics in the United States. I think that whenever you get a change in the White House, or whenever you get a change at the head of the Federal Reserve, you're a gold investor at your own peril. So I thought it was interesting that we were able to fit in a real, and I think meaningful, bull segment in gold and gold equities in between this sort of abrupt move upward in the gold price starting in, let's say, February or March, and the election in November. And I think a lot of very interesting things happened. And one of the more interesting things that people, I suppose, have had fall out of mind at the moment is that you had many of the highly levered producers able to raise in significant quantities. So once gold started to move in March, it wasn't long before Equinox was suddenly able to raise 975 million US dollars to buy out Orion's share of Greenstone. It wasn't long before IAMGOLD was able to raise $300 million to buy back a portion of Cote from Sumitomo. And it wasn't long before New Gold was able to raise close to $300 million to buy Teachers out of, I think, New Afton. And I looked at this, although I was somewhat distracted by developments at one of the companies I'm on the board of during this period. But I looked at this and I thought, well, this reminds me an awful lot of September, October 2009, when Barrick was able to raise $4 billion in a stunning secondary to buy back their hedge book. And that, I think, coming on the heels of the 2008 financial crisis, marked the next major leg up in gold equities. The Barrick hedge book was offshore, and it worked fantastically well for them when gold was going down in price. But when gold started to move persistently up, even though a lot of their hedges were deferred, they could deliver against spot and defer delivering against the contract price for some time. I think they thought that the writing was on the wall. So Aaron Regent made the very difficult decision to do a $4 billion equity issuance and buy back that hedge book. And it wasn't just the trend in gold prices, but the fact that as that hedge book began to become a net cost, it was not tax deductible because it was located offshore. And so I think when I saw Equinox and IAMGOLD and New Gold raising to collectively close to, let's say, $1.7 billion to buy back portions of their assets that they had either sold or had partially sold through financing arrangements. To me, that looked an awful lot like Barrick's repurchase of its hedge book in 2009. And I thought that it probably signified or might be a signpost for the beginning of a new bull market in gold equities. And for the moment, I'd say the jury is it's more of a subjective question whether or not you've experienced. If you owned Lundin Gold, if you owned Alamos, if you owned Orla or Calibre or Coeur Mining, even, I think you've had a fantastic first leg up in a gold bull. Mm-hmm. If you owned the beta in the sector, if you own Newmont or Barrick, and when I refer to those names as the beta, because we're in an indexing and a passive world, the GDX and the GDXJ, they need big liquid equities to make up the bulk of those indices, and then there are alpha generators around those big companies. The beta has been the problem in the sector. Barrick and Newmont, Franco-Nevada, Wheaton Precious, these companies, there's only, I think 4 or 5 of them that make up almost half of the GDX, for instance. So the beta is so scarce. Big liquid equities with lots of market cap and lots of production are so scarce that the beta gets priced efficiently very quickly. And then it moves with the gold price, and it moves with input costs, and it moves with their own growth prospects, which are horrid. So it's a really, really interesting sector. It's
Newmont has gone. Sorry to interject there, but I want you to catch your breath, and then let's keep going down this road. So it's interesting to see Newmont go from in October, you could arguably say it was trading at a premium valuation with a multiple that was pricing in some growth, quite a bit of growth maybe, to now it's like at a deep value, it's trading, I don't know, less than 10x its forecast, earnings for 2025. It's almost never traded at a 10x, multiple in the time that I've followed the sector. At least it's always traded at 15 to 20. Newmont seems quite troubled, and they've been selling off these non-core assets in 2024. It seems like they're most of the way through that process, but there's still a few more projects that need to find buyers. What is going on with Newmont? And it's really notable that some of the acquirers of these assets have traded very well on the back of the closing of those deals.
Mm-hmm. Mm-hmm. 2 questions there. So let's start with Newmont, or as I like to refer to them, the U.S. Department of Gold Production. So Newmont is a big bureaucratic company. It's a government. I think it'll be interesting to see who Trump appoints to run it, whether they make it through confirmation in the Senate. And I kid, of course, on that. But and I think actually I listened to a really fascinating interview that Antonio did with David Finch the other day, and he makes the argument that in most industries, the bigger companies have the lowest costs because of economies of scale, but in gold mining, it isn't true because of managing complexity. And that's a really interesting remark that I think we could talk about for an hour. And David is a really interesting guy. And I don't want to advertise someone else's podcast here, but go find the interview and listen to it. It's fantastic. And I know you're friends with Antonio and Luke, so so I think you can argue to some extent that that's true. And then, of course, the question is why. And I think you just need to look at enrollment in the mining engineering programs around the world and the way that those programs have been of interest to no one for the better part of 20 years now. And I think the crisis in the industry is at the engineering level, and the crisis in the industry is at the scientific level when it comes to exploration. And so as a result of that, the larger these organizations get, the more difficulty they have in finding talented people to run their various far-flung operations. And so to some extent, the movement towards consolidation has only created human resource problems at companies like Barrick and Newmont that have centers of operation in Nevada and in Australia and in Africa and in Suriname and many of these other places. So I think if you have truly only, what does Rick Rule say? 20% of the people create 80% of the utility. I think it's probably gotten much smaller in this industry as fewer and fewer talented young people have decided to pursue careers in resource extraction. And what you result, or what the net result of that is that you have a very small group of people overstretched in the responsibilities that they have to solve problems at and to optimize large and complicated mines spread around the world. And that's counterintuitive to the way most industries work, where the bigger you get, the lower your costs fall.
Yeah, that's well said. Newmont, and I could say the same for Barrick. These companies seem too large, and they're managing operations across continents. So they're not only dealing with science and engineering and people, large numbers of employees. They're also dealing with different politics, governments. It's complicated. I think what you said, that they're managing complexity, is apropos.
Well, and just to be clear, David Finch said that.
David
and I
Finch,
agree.
yes, yeah.
Let's make sure that we give him credit
David
for
Finch,
that.
yeah, he's a portfolio manager that's based in Paris, right?
He is, yeah.
Okay, and he focuses on the gold sector,
among others, yeah.
Okay, yeah. So he knows the sector very well. So Newmont is the number one. It's the largest gold miner. It's the largest market cap. It's the one in the S&P 500, but it's also terribly hated company. Investors really don't like it. The returns the stock has created over large swaths of time are, to be kind, lackluster. You do much better just buying a gold bar or a gold ETF. Is there any hope for this company to turn things around? I mean, we've been talking about a turnaround here for a couple of years. It doesn't seem like it's actually come to be yet.
That's another gigantic question. And given that I'm on the board of 3 juniors, and one of them is in gold mining, I think that I want to be respectful to the bigger companies in the business. And so I would say, I mean, Newmont is such a fascinating company when you think about its roots under the Colonel William Boyce Thompson. It was really just a holding company for various investments over the years, and it has owned interests in many other public companies over the years, and it was largely a copper company until the discovery of the Carlin Trend, really by, I think, John Livermore, who was working for Newmont at the time. It's a great story. And when Carlin was discovered, I think Newmont was run by Plato Matsalamov, who again was a very interesting eclectic guy who got Newmont into coal. They owned Peabody for a while, and they own one of the largest cement operations in the United States for years as well. So this is a 100-plus-year-old company, which has a lot of intellectual property in its history, some of it not of use, some of it continuing to be of use. And I would have to believe that there are talented people there who have scarce knowledge that will be very valuable going forward, especially if we're truly only in the beginning of a gold bull market, and we can talk about that later. But they're going through a difficult time now rationalizing the business to optimize it for the management talent available to run it. And again, that's just, I think, the theory that we've advanced earlier in the conversation. And if that's the theory that we're working with, I think they need to right size it so that the talent isn't spread too thin across the breadth of the organization. And there's plenty of fantastic minds there, plenty of long life assets there, plenty of collective knowledge, massive databases, which I think, in theory, if artificial intelligence becomes an important part of this business, actually owning data will be incredibly important in this business. And the companies that have the most data will likely have a competitive advantage. But all that's in the future at the moment. And right now they're going through a right sizing. And but I would imagine that if we're in a gold bull, that this large ship will eventually get turned into the right direction and begin to cruise.
Okay. Yeah, it's interesting how, Newmont really fell on hard times in Q4, where the stock was having a pretty fantastic year right up until mid-October. Actually, it had almost doubled, right? So that's a stellar year for a $50 billion, market cap company. But then the Q3 report on the third quarter, and then the guidance was pretty disappointing. And I believe that, investors such as myself were thinking, this is finally the time for Newmont to shine. They're having $1,100 per ounce margins. It's a back half, weighted year. They kept talking about how, the Q4 is going to be a fantastic quarter for the companies. So we don't know what the fourth quarter was yet, but the guidance that they gave sort of tempered some of the hopes for how good a quarter it was going to be. And then all these asset sales, right? Which, you said they're right sizing their operations. They only have so much talent, across their operations. There's only so many people that have wanted to come into the mining industry and learn engineering and learn exploration, and study it and get good at it. So their growth prospects may simply just not be as good as they once were. Like I can recall having conversations with a fund manager in Palm Beach 10 years ago, and he was telling me Newmont's going to produce 10 million ounces gold equivalent a year. And so it's a simple company to analyze because 10 million gold equivalent ounces. What's the gold price going to be? Here's the margin, yada, yada, yada. He had a very simple model. His model was completely wrong because that's not the way the business has played out. right? And
Mm,
I think that's been very frustrating for investors who wanted to have a simple way to bet on gold.
hmm.
And it's just not been that, it's
Sure.
just not been the case. It's just way easier to just buy gold, right?
Well, I think that, and again, I've got many friends at Newmont, so I want to be careful how I say this. I think that the Goldcorp acquisition, in retrospect, looks like a massive mistake. And at the time, I think a lot of us thought that it was a mistake, that it was a vanity acquisition. And of course, the crowd that engineered that acquisition is gone. And what did they buy? Timmins over. And that's an asset that's on the block. And I guess it's rumored that Tony McCooch has a vehicle that will get that. Maybe it's going to go into Discovery Silver. Maybe Tony has a new vehicle. So that's one further non-core asset that's going to disappear supposedly. Coffee in the Yukon. I'm told it's for sale for $20 million. It was bought for $400 million.
Wow.
Muscle White getting sold. And a lot of the stuff that Goldcorp took over in Chile, like Exeter, as an example, and that whole copper gold complex down there, which now I think is in a partnership with, is it Tech or Barrick? I can't remember. Norte Alberto or something like that. In any event, I can't remember. There's a couple of partnerships down there with copper gold porphyries that were bought by Goldcorp that need partners because desalination plants are part of the strategy there. And of course, those are enormously complex things to build on their own and capital intense. So I guess a bunch of the large companies down there are joining together and putting their minds to partnership to address the water issues. So that acquisition, in addition to not delivering growth, also made them vulnerable to an unsolicited offer from Barrick, which had as its real motive getting Nevada into a joint venture that Barrick would be the operator of. And so, in addition to not delivering the growth that Newmont was looking for, it also forced them into a subordinate position in having to accept a non-operating partnership in Nevada. And I looked at all of the consolidation that was going on in the market at the time and was worried about it as a junior investor because, of course, fewer big companies, fewer competitors for projects. And so my own personal feelings about it were negative. But as an investor, thinking about, as a stock picker, I guess, as an investor, I also worried that consolidation for the sake of consolidation in order to be a bigger constituent for passive strategies was yesterday's news, and that it wasn't going to be good for the gold producer companies. And I guess that's borne out. So Newmont in particular is really struggling to digest an acquisition that was potentially not done for the purposes of becoming a bigger, better, leaner, more profitable company, but rather for becoming better beta for passive. Mm-hmm. And I can't, that's an opinion. It's not a view. I'm sure that there were very intelligent decisions made in the boardroom in Newmont when they thought about taking Goldcorp over. There were expectations that appear not to have been realized, and it's a really, really big pig that the python, I think, has just about digested. And maybe it's the right time to buy Newmont stock now that we talk about it. I'm not sure.
Yeah, it's certainly hated enough right now, and it's oversold enough. But man, what a dreadful last couple months. So that's enough about
and
that.
to be clear,
Yeah,
the people running Newmont today didn't make those decisions.
Right.
They are dealing with the consequences of those decisions. I have many friends at Newmont who I think are extremely talented people who would have loved to see more capital allocated to the things that they were doing, and I think that reservoir of talent and data is going to be very valuable if we're going into a real bull market in gold.
Yeah, and I want to go there next. The health of the sector, the real bull market in gold. But first, I want to touch on one thing that you mentioned very quickly because I think it's important. The coffee acquisition, that was a $500 million acquisition in 2015 by Goldcorp of Kaminak Gold. So when Newmont acquired Goldcorp, they got coffee, by default, essentially. And to just think of it, if that's correct, that it's for sale for 20 million, or even if it's 50 million, it's still a huge
Mm-hmm.
loss.
Mm-hmm.
You got to think about Goldcorp and Newmont have held that asset for a decade. So what are the holding costs? How much have they sunk into it permitting?
Mm-hmm.
Yada, yada, yada over 10 years. You're definitely talking in the tens of millions. It might even be 100 million. I don't even know.
Mm-hmm.
But a lot of shareholder value just bled out there in a project that doesn't look like it's going to be a mine, or it's not going to be a mine anytime soon. And it's those kind of acquisitions that occurred during that 2010 to 2016 timeframe across the sector. There were a number of them. It wasn't just coffee. There were many that cost shareholders,
Mm-hmm.
investors across the space a lot of capital. And
Mm-hmm.
and we've been paying the price for those bad acquisitions for a decade now. Are we finally through it? Maybe. So, I want to go to the overall health of the sector because I think you have some really important things to say about this. So the juniors, not fantastic in 2024. The seniors, not fantastic in 2024, but the mid tiers actually performed really well in 2024. And especially if you go from the low water mark in March to the high water mark in October, some really stellar moves across the,
Mm-hmm.
mid tiers. And this is a point that you've been making for over a year now, that really for this gold bull to really go to the next level and really be the real deal, we need the leadership from the mid tiers. So David, tell us what you think about the health of the sector, and is this bull market actually about to really take off now?
Sure. And I guess just to give everyone context, over the course of the 3 or 4 years that you and I have been having periodic conversations, and I think in some of the other conversations I've had from time to time, I've referred to the need for a more vibrant middle market, champions in the middle, lions in the middle, to put pressure on the majors in competition for projects. And over the history of our market, there has always been one or a group of companies in the middle that have competed for assets which might otherwise have gone to major companies, and they have helped stimulate very healthy markets for mergers and acquisitions. And Goldcorp was one of those companies many years ago. Glamis was one of those companies. Yamana was a roll-up company. Meridian before it, I suppose, was a bit of a roll-up company. And it really looked like Tahoe would be the roll-up champion of the last market. They had the fantastic Escobal silver mine in Guatemala. They bought Rio Alto. They bought Lakeshore, and they were rumored to be in the running for Richmont. And then Escobal was effectively expropriated, and Tahoe became roadkill, eventually taken over by Pan American. And they don't have Escobal back in production yet, despite the fact that I think they thought Escobal would be in production a couple of years ago now. But politics have been very, very difficult in Guatemala. So I think when Calibre took over Marathon, this was going to be a really interesting experiment. Marathon, Canadian gold opportunity, fairly transparent. Its problems, but also fairly transparent from the standpoint of the permitting regime. It was a bit of a victim of capex inflation around COVID, and Calibre, which was minting money in Nicaragua, decided that the time was right, and they did an acquisition of Marathon that at the time was somewhat controversial. Their big shareholder, B2Gold, had been rumored to have had a look at Marathon and wasn't necessarily interested in it on their own account. So that was probably about $1.20 a share. And I think that today Calibre trades over $2 a share. And what followed that were some fairly hefty capital raises, but at higher prices. And it worked. And it was a really, really interesting, I thought, experiment for the market. And since then, Orla has taken over Musselwhite recently. That's gone from a $6 stock to an $8 stock as a result of that. Of course, Pierre Lassonde and the team behind that have a lot to do with the success. And I don't want to discount Jason and the whole team at Orla, but Orla itself has a very powerful network behind it and is always going to be a premier destination for capital from gold investors. But in addition to that, SSR mining, which had been hobbled by the tailings collapse at Çöpler, took over Cripple Creek, 100-year-old asset, more than 100 years old. And in a very clever deal that capped the closure liabilities, passing anything above $500 million on to Newmont. And SSR Mining went from being about a $6 stock to 12 and then 10, I think. Coeur Mining merged with Silvercrest. And what else has happened this year? I think Alamos taking over Argonaut. I mean, that was a no-brainer, obviously. That was going to be massive capex savings because of the mill that was built there and all kinds of tax pools. And so all of these companies have been rewarded for growing through acquisition and have had performances that have been starkly in contrast to the beta in the indexes to which they belong. And throw in Lundin Gold and Torex and K92, Wesdome. These smaller companies with fewer assets are being rewarded for margin. They're being rewarded for growth through acquisition. And I think this is the most important ingredient in creating competition for projects going forward. And this is a long-winded answer, but I'll finalize by saying this. G Mining, a development story when it took over Reunion Gold, on the verge of production, but not quite there yet, should never have been the owner of Oka. Barrick was in pole position there years ago in a strategic alliance in Guyana with Reunion. They took a pass on this project. There was litigation between the companies. How on earth did Barrick miss out on owning this very, very promising discovery in Guyana? And I call it a promising discovery, even though it's already reached the development stage, because it's a great belt and there's lots of potential. And obviously there's implications for G2 Goldfields there as well. But this trend is likely to continue. I don't know who's going to own Snowline. I don't know who's going to own Rupert. I don't know who's going to own Founders. There aren't a lot of world-class projects out there that are new districts where you have one fantastic new discovery and the potential, because of the land package, for multiple discoveries to follow. But I would bet that one or two of those really, really promising new camps are going to end up in a mid-tier and not a major, despite the fact that it really, really should be a major that buys, any one of them. And I can't speak for Founders. I don't know that much about that, actually, but it is really promising. Really, who's going to own Snowline? Who's going to own Finland? Let's see.
Finland. Politics in Canada a little bit, and maybe some, I don't know, glass half full for Canada, for the venture, for mining. But I also want to talk about, so yeah, let's go with Canada first, and then we can talk about, investor psychology as the last topic. So uh, I'm not, I don't want to get into politics too much, but obviously the Prime Minister of Canada is unpopular now. I think we can assert that safely. He looks to be on his way out in 2025. The Conservative Party is now very much more popular than I can recall in quite some time in Canada. Though the loonie, the currency of Canada, is flat on its ass as one of the most hated currencies in the world today. The exchange rate versus the US dollar is 144, very high, very high. It's fallen quite a bit in 2024. What is your outlook for Canada, David? And would a Conservative Party win be good for the junior mining sector?
Again, really, really big open question. So let's start with the last question first. Would a Conservative Party win be good for let's just call it the natural resource sector or the exploration sector, since what we do very well in Canada and Australia is mobilize capital to the high risk aspects of this business. There was a change in capital gains rates late in the Trudeau regime, which has not yet been passed into law. There's speculation on whether or not Poilievre, if he got into power, would not go ahead and put that change into law, or whether if it made it into law before Conservative government got into power, whether or not that would be rolled back. When you increase capital gains taxes by 30%, you probably inhibit some investment into this space. Capital gains rates are meant to be lower than income rates to create an incentive for people who have earned income and paid taxes to risk it on other people's dreams. And I suppose to some extent, vicariously their own dreams. And if you want individuals who have worked hard, made money, and paid taxes to take their savings and risk them at higher and higher levels of risk, the degree to which capital gains taxes are increased will, I think, logically reduce the amount of risk capital available as risk increases. You have fewer wins, you need your wins to amortize your losses, and if you give away more of your wins in taxes, then you're likely to put less money into higher risk ventures. So that's one specific consequence, I think, that could happen under a Conservative government. And I don't know for sure. It's just a thought that I have, and a possibility. So this is one possible consequence of a sooner than later change in government. When it comes to the Canadian dollar, that has put a massive tailwind behind the gold mining sector in Canada. It's part of the reason why Agnico Eagle has vaulted up to become the number one gold miner in the world. If you think about the Australian dollar and all the damage that it took after, let's say, 2010, 2012, the Australian dollar gold price, I think, had one of the sharpest ascents between, let's say, 2012 and even today. And you had Northern Star, Regis, Carora, I guess, Westgold, Saracen, DeGray. You really had a vibrant market for gold producers and gold equities, and growth, bootstrapping of major and mid-tier gold companies in Australia, partially as a result of the Aussie dollar gold price, and partially as a result of the fact that it's just easier in some places in Australia to build and develop gold mines, just from a climate standpoint, not to talk about regulations, because there's different regulations in different parts of Australia. So I would guess that, as painful as a low Canadian dollar is for many of us, it's really going to deliver a competitive advantage to Alamos, to Agnico, to IAMGOLD, probably to Kinross if Great Bear comes along soon enough. And certainly you can see a load of excess capital coming out of Agnico and going into Foran Mining, ATEX, Canada Nickel. And that's probably in part because their costs are in Canadian dollars and their revenue is in USD.
Their product is a natural hedge to the currency that their costs are priced in.
The margin for Canadian gold miners is positively correlated to a drop in the Canadian dollar.
Exactly.
Mm-hmm. Mm-hmm. Mm-hmm.
So,
and I guess I should forget to mention Wesdome in there as well.
So a weak currency may not be great for the unhedged investor in Canada, but because the purchasing power of their currency drops, but it may be good for their investment portfolio if they're holding gold miners based in Canada with their core operations in Canada.
Alamos is a fantastic example of this. Of course, the company was all about mulattoes all those years ago, an oxide gold deposit in Mexico, really great rock conditions, great leach kinetics, and low purchase price, and bootstrapped into what eventually became a portfolio that included Young-Davidson, a bulk underground mine with questionable economics, and Richmont, the Richmont purchase, which is a beautiful and growing high-grade underground opportunity, and now into the corpse of Magino and all the capex and tax pools that it generated. And so Alamos, I suppose, in one respect, has been the perfect investment for a Canadian who has suffered under some of the decisions made in relation to energy and trade competitiveness.
Final question. We talked about beta in the gold mining sector. Examples of beta would be Barrick, would be Newmont, and the beta, the results of just holding gold mining sector beta over longer time frames is pretty dreadful. I think we can all agree on that. So instead of beta, let's generate alpha. So generating alpha in the gold mining sector usually requires a deeper insight, a variant view, and a willingness to be a contrarian. As Rick Rule says, you're either a contrarian or you're a victim in this sector. So that means buying well, buying low. Can you expound upon that? Maybe give some insights or advice in terms of contrarian mindset. Like we were talking about Newmont earlier and how down and out its chart is, the share price is, and maybe it's actually kind of interesting here at 37. As Rick Rule says, he loves hate. Newmont is hated, makes it a little more interesting. So how do you buy well? You know, how do you take on a contrarian mindset that can actually, uh, generate alpha?
Hmm. Well, to some extent, it depends on how you organize your own portfolio duration. So I think the the individual investor has an advantage over institutional money when it comes to these long cycle opportunities, because you don't have quarterly redemptions or daily redemptions or monthly redemptions. And therefore, if you want to take some portion of your capital and allocate it to longer duration opportunities, you can do that depending on the structure of your own life and your own needs. And so I've always thought that this sector is far more suited to individual investors, and particularly to individual high net worth investors, than it is to uh, various strategies that are marketed as financial products. The Canadian mutual fund sector, as an example, where they give daily liquidity to investors and where you struggle to keep inflows into precious metals funds or natural resource funds, because returns are so volatile and uneven. So it's no coincidence that Eric Sprott, in the long run, has been one of the big winners in the sector. And I mean, obviously, Eric has had a difficult couple of years, not just from the standpoint of returns, but from a family standpoint. And nonetheless, is both in outlook and temperament still maybe one of the best suited investors for assessing and taking risk in this business. And I think we all cheered as he made north of $1 billion on, pardon me, on Kirkland Lake, and I was very pleased to see some of his bigger positions really benefit from the run up in gold this year. And all of a sudden, you could look at just Jaguar Mining and Free Gold Ventures, and I mean, they're just too numerous to name. Discovery Silver, you all of a sudden hundreds of millions of dollars of market cap added during that run up in gold. And of course, the trick is always to make that liquid. And Eric, takes pretty big swings, and if any one of them wins, I mean, they all have $1 billion potential, I suppose. Not all of them, but a lot of them do. And so, and I think, there are a few other individual investors out there who, like Eric, are capable of taking risks, capable of being patient, who often end up becoming filers, and who can write checks that keep the enterprise going when capital markets are tough. And so if you look at Artemis Gold, Stephen Dean's brilliant mine builder, very, very good at buying low and selling high, as Atlantic Gold demonstrated. Ryan Beatty was an incredibly important component of that success. Made a lot of money in real estate. I guess I don't know Ryan personally, but Ryan wrote some multi-decamillion checks for Atlantic Gold, was a big buyer in the stock market, and ultimately crucial in getting that mine built, supplying lead orders that generated the rest of the capital, and probably crucial in getting that company sold to St. Barbara, which was an ill-fated acquisition, unfortunately. So when I think about investing in companies in this sector, I'm a little happier if all of those ingredients are in place. And that doesn't say that I necessarily follow Eric or Ryan or Larry Childress or Ross Beatty into names in particular, or Pierre Lassonde and the Trinity Group or the Lundin family. But I think that there's an array of investors and companies that are patronized by them that rise and fall as commodity prices rise and fall, and where you can safely pick stocks through the cycle. And so one of the things I think is, that investors should look for when they're looking at junior companies is sponsorship. And that's to say, is there a network attached, or are there multiple networks attached? In G mining, I gave a presentation at PDAC where we talked a little bit about this, about these stocks that had fared well in a difficult market, like G mining, which was a development company that really had no business doing as well as it did on an asset like TZ. But you had Franco-Nevada invested, you had La Mancha invested, you had the Lundins invested, probably the Trinity Group was in there as well, although they weren't visible. And so I think when it comes to being a contrarian in this space, try to be part of a team when you're selecting investments. And there are many, many opportunities to buy companies that aren't networked, but which have a competitive advantage based on management and their model. Coeur would be a great example of that. Those boys, Zach, did an incredible job monetizing a joint venture there, turning it into cash and a royalty, and turning some of the other portfolio investments into cash, like the Lyft investment. And now you have, in theory, a prospect generator that's extremely well capitalized, that looks at a sector that's a smoking bomb crater, and has its pick of opportunities. And is that going to be the next Altius? Who knows?
Coeur has been a fantastic story, really a master class in how it's done for a project generator. And it's funny you say smoking bomb sector. Yeah, I mean, there's a lot of opportunities out there for those who are astute and able to identify value.
Mm-hmm.
The tricky part is being able to, identify value, because like we've, recited in this conversation, you mentioned, the Atlantic Gold acquisition. We talked about coffee. I mean, these were acquisitions made by some of the smartest guys in the room, some of the biggest checkbooks in the sector, and they turned to be disasters, So
Mm-hmm.
it's
Mm-hmm.
very tricky, very tricky.
And I would argue that they wouldn't even be visible disasters if those companies still existed. So, I mean, consolidation at the top of this business has been really disastrous for projects and for small companies. Newcrest disappeared, Goldcorp disappeared, Yamana disappeared, Kirkland Lake, which was supplying a load of capital to the industry, disappeared. And so the dollars, the bank accounts swelled as all these companies came together. The CapEx bills, the forward CapEx bills swelled, and the number of companies going after projects reduced dramatically. And so the same can be said for institutional investors in the space. Really, we've just continually had retrenchment there, with the odd bright spot. So I can't remember when Crescat formed, but for a while they became an incredibly important part of investing in juniors. Not only
2020, I think.
Yeah, not only did they write some really important checks into juniors, but they were very savvy when it came to using social media and talking about the things that they were investing in. And eventually they concentrated a lot of their efforts on Bolivia and taking over. The name of the mine escapes me, from Sumitomo. San Cristobal from Sumitomo. Thank you. And hopefully that will be a fantastic investment for them. But they, at that point in time, became a less important supplier of capital to the remainder of the junior markets, as they concentrated on that opportunity. And Forest Sail came out of nowhere to be a big supplier of capital, a big check writer to the industry, and they've sort of retrenched. The same was true of the last cycle, where you had Osprey and Rab Capital that were writing enormous checks, and then bought into too many liquid stories, got redemptions, and ceased to be major forces in mobilizing capital into the industry. Sentient, another great example. So the supply of capital to this industry is extremely volatile. And every company needs to think about the way they run their business to be responsive to that. They need to be able to shrink their use of capital when capital is unavailable, and be ready to go on offense when it is available. And it's a very, very complex business. Hard to make money in this business. It's hundreds of years old, very well understood, and very efficiently priced. And because the odds of success are so low, in a normal market, these companies trade at low prices and high costs of capital. And we're certainly not even in a normal market at the moment, but in a market that is still digesting a reduction in capital from the Canadian mutual funds. And the good news is, I think that that's almost over. The sector figures out which companies are relevant and gets capital to them. And then you have 1,000 zombies that struggle to raise capital and become shells, or that have an asset that doesn't require a lot of capital and that can make it to the next cycle. And that's normal course of business in this business. And so I don't know what the conclusion from that was. It was more of a soliloquy.
Yeah, it was. It was. Yeah, it just, I basically threw out that this is a tough business. It's a tough sector.
Mm-hmm.
And some of the smart guys make really, in hindsight, dumb investments, but always in hindsight. And it's tough to tell in foresight.
Sure.
But David, fantastic conversation. I think we're almost at the 90-minute mark. This is a real treat for the viewers. It'll be interesting to look back on this at the end of the year, the things we talked about, and maybe what is going to play out this year. I think we're both reasonably optimistic for 2025. The fact that the mid tiers have their groove back, it is positive, and it seems to be a not so abnormal bull market cycle playing out. It just hasn't really gotten to the juniors yet. We're just not there yet. We may not even be there in 2025. We'll see.
Mm-hmm. Mm-hmm. Well, all of this tale of woe and pain and sacrifice are offset by the necessity of the sector to the advancement of mankind. And even gold, it seems, despite the fact that it isn't copper, it doesn't help run electric cars or create the grids that electric cars will be charged by, I think continues to be an incredibly important asset for the reserves of central banks around the world, and even more important today than it's ever been, given the way in which finance was weaponized around the Ukraine situation. So it's a sector that can be boring and difficult at times, but ultimately has to deliver returns, or mankind runs out of stuff.
It's a very important point, and I think that is a preview in some way of what I'm going to talk about in Vancouver in a couple weeks. The mining sector is integral, and it just doesn't get a whole lot of love. But maybe we can help to change that. One by one, we can make a difference, and maybe some of these big companies, like we talked about, like Newmont, can do a little better job on the marketing front and on the PR front. I think that's something that has been sorely lacking in the mining industry for a long time. But let's leave it there. I hope to see you in Vancouver in a couple weeks, and do this again in the next couple months. Thank you, David.
Great. Thanks so much, Robert.